Hello, everybody. I am Jorge Montepeque. Welcome to another episode of The Officials. Thank you for watching. Don't forget to like and subscribe. So, I am going to be with my colleagues here from The Officials, and we are going to be discussing the latest market developments. We have a lot. And one of the issues we always have is about choosing the topics because there's so much going on the markets. So we want to be focusing on some things that I think are very important to you as a watcher and as a market practitioner. The main issue we are seeing, which I think influences your life and your decision making, is the poor data quality. We all rely on numbers, on data. We don't want to rely on feelings. We want to rely on facts. Everything we do needs to be factual. And then we question, how can we make good decisions if the data we are receiving from trustworthy agencies and governments is perhaps not to be trusted? Let me give you some examples. My colleague here, Will, has put together some figures for me to share with you. This week, the API showed crude inventories going down by 5.2 million barrels. The first thing we noticed overnight, and maybe I'm going to put you on the spot, Will, is what did the market do when the APIs were released?
Well, there was almost no reaction, Jorge. Flat price was trading range bound, and yeah, there was almost no reaction in flat price to the huge draw.
So the market received data that inventories were dropping by over 5 million barrels, and it did nothing at all. Was that the right decision or the wrong decision? Question mark. So we, as the rest of the market, waited for the next set of data, which comes the following day from the US EIA. And those crude inventories showed an increase of 1.35 million barrels. So the disparity between the two is, say, 7.5 million barrels. So we would say, please, agencies, get your act together. But what did the market do when the increase in inventories was reported by the US EIA?
Well, it had a reaction. So the flat price Brent shed about 30 cents in the 2 minutes after the announcement.
So what we saw this week is that the market is trusting the EIA and is not trusting the API. But one should ask, why are they coming with such wide difference in numbers? And should maybe want to stop doing it if the market doesn't trust it anymore? Because if there's an item of data that is valueless, then why spend time on it, right? Dr. Wu, we always want to do things that are factual and forceful and have an impact, don't we?
Of course we do, and in the oil market, the facts may be difficult to come by sometimes because ultimately the EIA stats from their website, even they talk about it as estimates. So there's some plausible deniability that it's not the concrete end all be all number, but it does seem that traders see EIA stats as slightly more reliable or trustworthy than API in the sense that they trade relative to each other. So if, let's say, this week EIA stats showed crude build against an API draw, then that is interpreted as bearish, so which would lead to them selling crude flat price.
I think you hit it. Everybody wants to have plausible deniability about something that maybe you don't know very well. But if you're trying to have an impact, I think you should do a better job, because what we are seeing here is a 7 million barrel difference between the two agencies for a market that is circa 20 million barrels a day. And that's a big percentage on a daily basis. So if we accept that, which I think we shouldn't, then maybe we're prepared to accept the differences between OPEC and the IEA. So let me read some data to you. The IEA maintained that the forecast for demand growth in 2024 would be nearly a million barrels per day. And OPEC, who I think finally is getting the message somewhere, decided to cut marginally the estimates of demand for 2024, but at only to 2.1 million barrels from 2.25. That means that between the two very trusted entities, there is over a million barrels of difference of demand per day. That equals to more than 300 million barrels missing somewhere over the course of the year. We're very, very, I cannot use the word upset, but wondering what are they doing? Because people make very strong decisions on these numbers. And let me tell you one of those examples. Aramco decided to issue a dividend payout, which if memory serves right, was 124 billion, based on super growth in demand and the great performance in China. And if one trusted agency says 1 million barrels growth and another says over 2 million, which number is the Saudi looking at? Of course, they're looking at OPEC's number, or nearly so. But OPEC now is kind of retracing back on what they see the demand being, but Aramco has already made a decision on this dividend payout. And how many other companies are making these decisions, which can be investment decisions, foreseeing some kind of demand? So where is the miss? We have concluded here that most of the miss is in which country, Mr. Wu?
Be the People's Republic of China. Well, there was a lot of hype over the past year about the economic rebounds, or which would translate into demand growth for crude oil post COVID in China. However, it does seem like the nation has been suffering a case of long COVID, we shall say, because the data shows that the demand has not been up to scratch. The crude oil imports are lower on a year-on-year basis. Yeah. China's exporting more in terms of steel. The property real estate data is also not performing up to analyst expectations. Recently, there's been a slate of bearish data overnight. So, for example, industrial production has eased to 5.1%, slowing by 0.2% from last month. Cement production has been falling year on year. Same with steel production. In fact, you had Hu Wangming from Baowu Steel, the largest, one of the largest steel producers in China, coming out yesterday warning about severe crisis in China's steel industry, citing weak real estate and poor demand from industrial production. As well as that, you had the highest level of steel exports in 8 years in the first half this year. So the stats paint a quite bleak indication.
What is the growth rate that China has estimated, famous word, for this year?
Around a target of over 5%.
4.75, I think.
4.875,
yeah.
Something around there.
So it's a little bit sub 5%, but that's a very healthy number that, based on the data you were just showing here, doesn't seem to square up. And Will, what are the things you haven't seen squaring up in China with the near circa 5% growth rate?
Well, PMIs have been really weak. So we've seen consistent contraction in manufacturing PMIs, which are obviously a survey of managers in the private sector. about whether they think employment's increasing or decreasing, if input prices are going up or down. So they're quite a good gauge of where the economy is right now, as opposed to some of the more backward-looking indicators. And yeah, like I said, they've been consistently contractionary and surprising to the downside. So not painting a particularly healthy picture.
And I don't know if you remember offhand, but also China today described or reported a reduction in oil demand month to month. And where is that coming from? If there is no industrial production, car usage, truck usage, then month on month, oil demand would drop. But it is almost like mandated by the Chinese government that the growth should be around 5%. And everybody else looks at that number and says everything is great. The Aramco chief also highlighted jet fuel demand in China as being one of the star performers. But Will, and you have worked on this, what are you watching on that front?
Yeah, I mean, there's been a lot of airways cancelling flights into China, into Hong Kong, as you know, Russian airspace continues to disrupt international flights, and yeah, it doesn't look particularly good.
Yeah, and the number of flights from China to the U.S. have not recovered. So maybe the Aramco chief, and we gotta be fair, maybe he's observing a super growth within China itself. And of course, we're gonna know that data in retrospect. But any other signals that I'm looking at coming from China are not healthy. So one of the things I have done is focus on the reports by foreign companies. And a Western oil company, a Western beer company has reported that its sales are down year on year. Starbucks just fired its CEO, and one of the reasons was because sales in China are down year on year. McDonald's was also having problems. So here are the officials. Just to clarify to you, we look at a broad set of macro and micro data to have a sharper view on what the oil market is doing. And really, as a group, what we are seeing from China is not very healthy at all. We would say that some sectors of retail are likely to be contracting. Construction is contracting. Industrial looks like it's contracting. And that also seems to be the case in the West. What are the latest data we have from today?
Yeah, so we just got a whole suite of US data. Industrial production that's just been released contracted by 0.6% versus minus 0.3% last month, and a consensus of 0.2%. It was a bit of conflicting data in the US really, because yesterday we had inflation come out at 2.9% year on year, and but that was lower than expected of 3%.
But let me interrupt you there. One could say that inflation is coming in below expected level because demand has been coming below expected level, and that tends to have a deflationary impact on prices. So that's not a healthy sign. That's actually an unhealthy sign.
Of course. Like for right now, I would completely agree with you. But what that does tell you is the Fed going to move in September? And will that then lead to a boost of demand in 6 months' time?
Well, we hope our stock holdings do better in September if the Fed is generous to us on the interest rate. So maybe we're a little bit vested there, not on oil, but in other general stocks. And anyway, in addition, we have seen this week very much separation between what we call the micro drivers and the macro drivers. The macro drivers continue to be negative week on week on week, with some sparse signs here and there of something positive, but overwhelmingly, on average, negative. Yet sometimes the markets spike by nearly, I don't know, $5 and more, $7 in a matter of 3 or 4 days, because the micros are in control. These things are always touchy for our viewers, but we have seen this week a lot of heavy buying in Asia by Vitol. And we also saw last week and beginning of this week some efforts again by Vitol in the North Sea. But in the last few days, we have seen a cool down of that activity, and I think a lot of the premiums are coming off. As it happened, yesterday there was again a few news about fines by the CFTC against Vitol for some going over the limits in oil, I believe, and surprisingly in the cattle market. And we were indicating that you can get heavily cornered between a bull and a CFTC enforcer if you're in a bad position. But anyway, I would conclude with the following, just your feelings about where we're heading here in terms of oil prices. Let me start what sometimes I feel is the bear, but go for it.
Yeah, I think flat price is feeling pretty heavy at the moment, and I think it wants to move down. Yeah, I'm looking at kind of a 75 floor.
And for you, Mr. Wu?
I feel that flat price could be supported at the $80 level. Weakness has, bouts of weakness has always led to subsequent violent corrections upwards. Post OPEC cut, we saw last week as well, hedge funds, CDAs, overcrowded on the sell side. So that could really likely have triggered a lot of short covering flows. You have geopolitical risk still in the menu. We're still in the summertime, potential risk of, for example, like hurricanes or refinery outages, severe weather, climate change. That could all lead to spikes in price action, or localized supply shortages or supply shocks, leading to more bullish action. And the market always likes to be bullish as well. So when they sense any of this sort of news, then all the bulls will rush in and keep prices supported.
And on my side, I am on the general macro level that things are looking quite bad, and until the Fed decisively act in the beginning of September. But I recognize that there are micro issues, and Mr. Wu just highlighted the fact that we're still in the hurricane season, and that may provide some very strong surprises in the next few weeks. But I'm also a little bit technical on the trading. What I feel today is that fluff in Dated Brent, which has been really excessive according to historical relationships, the pressure has gone off, and that will have some good news if you're a consumer, bad news if you're a producer. With that, I thank you very much for your time, and I'm looking forward to seeing you next week. Thank you very much.